Detroit is burning through cash at a rate that would have been unthinkable a decade ago. The electric vehicle transition is not just expensive, it is catastrophic for traditional automakers. And while American politicians talk about industrial policy and bringing manufacturing home, the real money keeping these companies alive is coming from thousands of miles away. It is coming from Riyadh. It is coming from Abu Dhabi. It is coming from sovereign wealth funds built on oil revenue, now being transformed into industrial power. This is not charity. This is strategy. And it is rewriting the rules of who controls American manufacturing. Start with the numbers. Ford's Model E division, which handles all of their electric vehicle operations, lost $4.8 billion in 2025. That is not revenue. That is pure loss. The company is projecting another $4.5 billion loss in 2026. These are not startup growing pains. This is a Fortune 500 company hemorrhaging money on a scale that would sink smaller firms entirely. Ford is not alone. The entire American auto industry has lost approximately $50 billion on electric vehicles over the past 3 years. Every EV sold by a legacy automaker in the United States has been sold at a loss. The batteries cost too much, the production lines are too new, the supply chains are too fragmented, and Chinese competitors are undercutting them by thousands of dollars per vehicle. Stellantis, the parent company of Chrysler, Jeep, and Ram, announced a $13 billion US investment in October 2025. The headlines praised the commitment to American manufacturing. Then came February 2026. The company previewed $26 billion in charges. That means write-downs, restructuring costs, and losses that dwarf the investment they just announced. The math is simple and brutal. They are spending more to stay in the game than the game is currently worth. General Motors is in a similar position. Billions invested in battery plants, billions more in retooling factories, and the payoff keeps getting pushed further into the future. The break-even point for EVs was supposed to be 2025. Then it became 2027. Now analysts are talking about 2030, maybe. This is a capital crisis. Traditional automakers do not have the cash reserves to sustain this level of loss indefinitely. Their credit ratings are under pressure, their stock prices reflect deep skepticism, and Wall Street is asking hard questions about whether these companies can survive the transition without outside help. Enter the Middle East. While Detroit struggles, a different kind of investor has been writing checks. Saudi Arabia's public investment fund now owns 64.3% of Lucid Motors. This is not a minority stake. This is control. Lucid is an American company on paper. It is headquartered in California. Its cars are marketed as American luxury EVs. But the majority owner is the sovereign wealth fund of Saudi Arabia. The PIF has poured billions into Lucid, keeping the company alive through years of losses and production delays. Without that capital, Lucid would have collapsed like dozens of other EV startups. The Saudis are not just passive investors. They are the reason Lucid still exists. Abu Dhabi is playing the same game through a different structure. The Emirates Limad Holding owns McLaren Automotive outright. It also holds 17.9% of NIO, one of China's leading EV manufacturers. Limad is positioning itself as a bridge investor, connecting Western brands with Chinese technology and capital. The scale of Gulf investment in the US automotive sector has exploded. Sovereign wealth funds from the region doubled their US investments to $70 billion in 2025 alone. A significant portion of that capital is flowing into the auto industry, either directly through ownership stakes or indirectly through supplier networks and battery technology firms. This is not traditional venture capital. Sovereign wealth funds operate on different timelines. They do not need quarterly profits. They do not answer to impatient shareholders. They can sustain losses for years, even decades, if the strategic payoff justifies it. And for the Gulf states, the payoff is enormous. Understanding why requires understanding what the Middle East is trying to become. For generations, Gulf economies ran on a simple model: extract oil, sell oil. Use the revenue to fund government budgets and development projects. But oil is finite, and the world is shifting away from fossil fuels. The Gulf states know this better than anyone. The strategy now is to convert oil rents into industrial rents. Instead of just selling barrels of crude, Saudi Arabia and the UAE want to own the companies and technologies that will define the next economy. Electric vehicles are a perfect target. The market is growing, the technology is still unsettled, and the incumbent players are weak. But there is a deeper game being played. The United States and China are locked in a technology war. Semiconductors, batteries, artificial intelligence, and renewable energy are the battlegrounds. Washington wants to decouple from Chinese supply chains. Beijing wants to dominate the industries of the future, and both sides need capital to fund the race. The Gulf states are positioning themselves as the neutral financier. They invest in American companies like Lucid and Ford. They also invest in Chinese companies like NIO. They are building relationships on both sides of the conflict, making themselves indispensable to both. This is not fence-sitting. This is leverage. Consider the structure. Lucid receives Saudi funding, which allows it to compete against Tesla and Chinese EV makers in the US market. NIO receives Abu Dhabi funding, which helps it expand into Europe and other markets outside China. The Gulf investors are not picking sides. They are funding both sides and extracting influence from both. For American automakers, this creates a dependency. Ford and GM need capital to survive the EV transition. Western banks are cautious about lending into an industry losing billions per quarter. Equity markets are skeptical. But sovereign wealth funds from the Gulf are willing to write the checks because they are not just investing in cars. They are investing in geopolitical positioning. The same pattern is playing out in battery technology. Gulf funds are pouring money into lithium mining, battery production, and recycling operations. They are buying stakes in the entire supply chain, from raw materials to finished products. This gives them influence over which companies get access to critical inputs and at what price. The shift from oil rents to industrial rents is already visible in Gulf economic data. Decades ago, nearly all government revenue came from oil exports. Now, sovereign wealth funds generate returns from global investments that rival traditional oil income. As oil revenue declines over the coming decades, investment income is expected to replace it. Owning pieces of the global auto industry is part of that model. If Lucid becomes profitable, the PIF collects. If NIO expands successfully, Limad collects. If Ford's Model E division eventually turns a profit, any Gulf investors in Ford's debt or equity collect. The Gulf states are building a diversified portfolio of industrial assets that will generate returns long after the oil runs out. This also insulates them from political risk. If the US government tries to pressure Saudi Arabia on foreign policy, the Saudis can point to their investments in American companies and American jobs. If China tries to restrict Gulf access to technology, Abu Dhabi can point to its investments in Chinese firms. Owning assets on both sides makes it harder for either side to cut them out. For American automakers, the situation is uncomfortable but unavoidable. They need capital. The Gulf has capital. The terms are not always favorable. Sovereign wealth funds demand board seats, veto rights over major decisions, and access to intellectual property. But the alternative is bankruptcy or a slow decline into irrelevance. There is also a national security dimension. The US government is nervous about foreign control of critical industries, but the Gulf states are technically allies. They host American military bases. They coordinate on counterterrorism. They are not China or Russia. So Washington tolerates the investments, even as it worries about the long-term implications. The question is, what happens when these investments mature? Will Gulf-controlled automakers prioritize American jobs and manufacturing, or will they shift production to lower-cost regions? Will they share technology with other Gulf investments, including Chinese partners? Will they use their ownership stakes to influence US trade, policy, or regulations? Nobody knows yet. The investments are still too new, but the structure is clear. Detroit is no longer controlled entirely by Detroit. The capital that keeps it alive comes from Riyadh and Abu Dhabi. And capital always comes with strings. Middle East is not bailing out Detroit out of generosity. It is buying a seat at the table for the next industrial era. The Gulf states watched the oil age make them rich. Now they are watching the oil age end, and they are using the wealth it generated to buy control of what comes next. American automakers are the vehicle, in every sense. They provide the brand recognition, the engineering talent, and the market access. Gulf Capital provides the money to survive the transition, and both sides pretend this is a partnership of equals. It is not. The side with the capital makes the rules, and right now, that side is not in Michigan. It is in the Middle East.